Uncertainty in the housing market grows, or perhaps I should say, it's growing. And making decisions or operating from a place of uncertainty is completely suboptimal. And in my experience, I found that when people are uncertain, they tend to get to fear and panic very quickly. And the fear of the unknown can completely debilitate you from making the best decisions for yourself, for your family, and for your financial bottom line. So, today we're going to do a deep dive into what's happening right now with some future forecasting in order for you to have some clarity and some certainty. And to be clear, I'm not an analyst, I'm not an economist, but I am a boots on the ground operator of a high performance real estate team. And I'm committed to telling you the truth and sharing what's happening now so that you're empowered and can advocate for yourself the right way. And if you've been watching for a while, you know I'm committed to sharing the truth about what's happening in each local housing market here in the state of Florida. Talking about the elephant in the room as far as economic conditions are concerned, because we are in a consumer based economy. And if the consumer does not feel safe, does not feel confident, does not feel certain, then they stop spending and they start to hoard cash in order to protect themselves financially. Everyone wants to have liquidity and cash available in the event of a doomsday scenario. And I'm not here to scare anybody. This is not going to be about a doomsday scenario. We're going to talk about what's happening right now today. And it was only yesterday that I talked about the unemployment number being the thing that we must be aware of. Because if the consumer is concerned about job stability or is concerned about their financial future or what their income will look like moving forward, because if the fundamentals of the consumer change financially, every single market is at risk. Which brings me to today's data, which brings me to today's number. We didn't have to wait very long for me to confirm what I already knew was going to happen, which is that jobless claims edged up to 198,000, which is a higher number than expected. And to be clear, it's not higher than what I expected. I suspect it's still underrepresented, but nonetheless, the number is higher than what many analysts had expected. And it goes on to say the jobless claims for the week which ended March 25th totaled 198,000, which is up 7,000 from the previous period and a bit tighter than the 195,000 estimate. And continuing claims, which run a week behind, edged up 4,000 to 1.689 million. And here's the whopper that I don't believe and I don't trust because I know these numbers are being manipulated. But the final GDP reading for the fourth quarter of 2022 showed the economy grew at 2.6 annualized rate in the fourth quarter. So nothing to fear here. The recession is canceled. We're back in the money because the economy and GDP are growing to the tune of 2.6%. And if you believe that's accurate and not subject to political intervention in order for people to be reelected, well, then I got a bridge in Margate to sell you. Nonetheless, it is what it is, and the stock market, which prices and changes instantaneously, seems to think this is good news, and we're off to the races. We're in the green. And some of the biggest bears out there, some of the biggest influencers that exist in the space who have been calling for total decimation in the markets are eating their words and retracting their statements. And keep in mind, I'm going to get into housing market data here very shortly, and we are going to go granular as to whether you should buy now or wait. But Michael Burry, the guy who's famous for calling the 2008 housing crash, publicly ate his own words and said he was wrong to say sell, and congratulates those who had the wherewithal to buy into the dip of market weakness. But to be totally clear, he's not talking about the housing market right now. He's talking about buying the dip that happened in the stock market in front of the last Fed meeting. But I suspect if you stick around and watch my analysis of whether you should buy now or wait, you might find some commonalities. And you might agree with Michael Burry that you buy the dip and sell the rip. And perhaps long term, we're experiencing the housing market dip right now. Yet to be determined, I don't know, but we're going to get into that right now. And as of right now, pending home sales upticked almost 1% versus a loss of 3% estimate. Analysts were expecting pending home sales to drop by 3%, and that's not what happened. And to be clear, I'm not talking hyperlocally. I'm talking about the overall macro picture of the US housing market. And Housing Wire's analyst is on the record as stating, in spite of this uptick, that the Fed will not be satisfied until they see a labor market break. And despite the fact that there's been an uptick in unemployment claims, I don't suspect we've seen anything close to a break yet.
Logan Madashami is the housing analyst from Housing Wire. He joins us now. So Logan, just put some of the housing data we were talking about with Diana, and whether we are seeing enough disinflation to make the Fed satisfied here, because shelter has been a big problem. What do you think?
I don't believe the Fed is going to be satisfied until they see the labor market break, which means jobless claims are going to break much higher than they are today. But the mortgage-backed security market spreads have gotten worse since the banking crisis. Mortgage rates should be lower than they are today, but the housing market has really kind of stabilized November 9th of last year when rates started to fall from 7.37% down to 6%. We've been kind of back and forth. So we've seen stabilization in that front, but the Fed is basically bent on kind of making the labor market break. So that is their disinflation weapon at this point.
I guess.
Now, to be clear, I've covered this in great detail in another video, which I will link above, which is called Layoffs Are Coming, because layoffs are coming. And so far, I have been 100% accurate in all of my predictions. And it's not because I'm so smart, it's because I am very experienced. And I've gone through every single crash that's happened since roughly 96 to about 2011. And during that time period, I was a financial advisor. I was a Series 7 stockbroker. I was actively trading the markets and making my clients money despite all economic conditions. And the truth is, I never made my clients or myself more money than when the market crashed, because that is when prudent, disciplined, opportunistic investors who have the wherewithal can change their net worth. And you can too. But let's keep going.
I was specifically asking about housing, though, because if housing prices go to 0% growth, that would do a lot, wouldn't it, for core CPI and an overall inflation?
Not really. If you look at core PCE during the housing bubble years when we had tons of home price growth, it was basically at the Fed target level. It's really rent inflation, and rent inflation has been cooling down now for some time. It's going to lag the CPI data. So home prices itself does not really push rent inflation up. So those are two different categories. Just for housing, over time, in about 12 months, the growth rate of rent will make that CPI data much lower. It doesn't impact the PCE data as much as the Fed's 2% target, but the Fed needs to just kind of endure this inflationary period and try not to create a job loss recession to get their 2%. And I think everyone will be more happy with that outcome than just pushing rate hikes and waiting for something to break and credit getting tighter and people losing jobs. That's not the most effective way to get through their inflationary targets.
It might not be the most effective way, but it is the way that they are going to do it. And don't trust me, just listen to Big Papa Powell, Jay Powell in the house, and he's told everyone what he intends to do. He will continue to raise Fed funds rates, and he will create mass unemployment, whether intended or unintended. That's what's going to happen. And again, that video will be linked into this one, so you can check that out too. And I suggest that you do.
Logan, a lot of discussion yesterday about Case-Shiller and the cities in the top 20 that are negative year on year: San Francisco, Seattle, San Diego, and Portland. And the Journal did that great map about markets basically west of Colorado negative and east of Colorado still positive. I just wondered if you think this can be contained to the western quarter of the United States.
Total active listings are near all-time lows. New listings data is negative year over year. So the areas that have the highest housing inflation growth are going to get hit price-wise, but definitely nothing like what we saw from 2006 to 2007, where we saw a mass supply of inventory everywhere due to distressed sales. So yeah, it can be contained as long as you don't have a really bad job loss recession. And the job loss recession lasts a very long time.
As long as we don't have a major unemployment crisis. And best I can tell, based on what Jerome Powell has said, that is coming. Now, I'm not rooting for that. That's not what I want. But hope is not a balance sheet item. I do agree it's very unlikely that we will see anything even remotely close to the 2007-2008 housing apocalypse. And I believe that there are certain markets which will be more insulated than others. But the inconvenient truth is that I don't see any way around a major unemployment crisis developing. And today's numbers are just the start of what I suspect is going to be much worse as we start to feel the pain of recession. But let's continue.
Definitely, we only see the really big housing hits on areas that really took off on home prices in a very short amount of time. Everywhere else is somewhat stable, and I think that's a good thing. That shows that the credit channels after 2010 have worked, and people are just staying in their homes and living in their homes longer and longer. That's a positive. So we can fight inflation without creating a massive job loss recession or housing looking anything like what we saw from the 2008 to 2011 period.
And with all that in mind, let's get into what's happening right now and give a more comprehensive overview of what the housing market is on a national level so that you can make the best decisions for yourself, for your family, and for your financial bottom line. And you can do your own due diligence to determine whether it's right to buy now or whether you should wait. And the first place for us to start with that is by talking about the 2023 30-year fixed rate. And as you can see on this graphic, which was taken from Mortgage News Daily Rate Index, you can see what the difference looks like between 5.5% mortgage interest rate and 7.5% mortgage interest rate. And it's pretty clear, and I've been talking about it for a long time, is that as mortgage interest rates hover closer to 5.5%, you have a lot more buyer demand that's able to go out there and purchase homes. And the more that increases and gets closer to 7.5%, what they don't have on this chart, which I think would be instructive, is a much higher gauge of what it looks like at 8, 9, 10%. But for now, this will have to do. What you can see is as we cross over 7% mortgage interest rates, there is much weaker buyer demand, period. End of story. Now, to be clear, this doesn't impact everyone the same way. There are plenty of affluent buyers out there or cash buyers out there that are not rate hike sensitive. They want what they want and they're willing to pay a premium to get it. But for the most part, those particular subset of the market aren't really thinking about whether they need to buy now or wait because they want to buy as of yesterday and start living their best life now and maxing out the utility of the home and maxing out South Florida living to the fullest. But I know that's not everybody, and that's why we're doing this analysis, which takes us to our next graphic, which gives you a visual representation of the 30-year fixed mortgage rate versus the 10-year Treasury yield. And what you can see is from January 13th, 2023, you had the 30-year fixed rate mortgage at a touch over 6.4% and the 10-year Treasury yield, which is represented in blue, at just under 6.8%. And the lowest dip this year has been to just under 6%, which happened in February. And that also coincides with the dip in the 10-year Treasury yield. But what's happened since then? Well, as you can see by this red arrow, it is straight boom zoom to the moon. And if housing and inflation don't start to cooperate and the Fed continues on their mission to stamp out inflation, I can promise you that both of these numbers are going to trend higher. And if waiting to buy is right for you, which again, there's no judgment on that, it's 100% based on what's right for you and your financial future. But the chances are that if you wait, your mortgage interest rate is going to be significantly higher. So when doing your due diligence, I think it's critical that you analyze what the future might look like at different mortgage interest rates and use a worst case scenario high ball interest rate to give yourself a complete picture of what the future could potentially look like. And then separately do it at lower rates too. But I'd rather you have the worst case scenario rather than the best case so you can budget and plan accordingly. Which brings me to the next slide, which I think is very important that you understand so that you've got some historical perspective. Because for over 50 years, the 30-year mortgage rate has moved in unison with the 10-year Treasury yield. And if you look back to 1980, you can see that the 30-year fixed mortgage interest rate was close to 18%, and the 10-year Treasury yield was north of 14%. And if we fast forward to 1990, 2000, 2010, but more importantly, 2022, you can't help but notice that the 30-year fixed mortgage interest rate has skyrocketed right along with the 10-year Treasury yield. And I'm not sure if this is Newton's law, but I'm pretty sure there's a saying which is that which goes up also must come down. And that's exactly what we saw. We saw a massive spike from 72 to 1980, and then a massive dip down to 2021. What do we see now? It's moving forward. It's going back up. It's skyrocketing. And while I hope that improves, hope is not a balance sheet item. Hope is not something you bank on, which brings us to a little bit more comprehensive analysis of the 30-year mortgage rate and 10-year Treasury yield. And you can see the average spread is 2.756. And this is just a fancy representation of saying what we already talked about. But you can see in January, the 30-year fixed mortgage rate was 6.45%. And in March, it's north of 7%. And the Treasury yield is upticking too, and the spread is increasing, which is no bueno if you need financing to buy a home, because at 7, 8, 9, 10%, you can likely afford significantly less home. And actually, I should say that differently. Significantly less money will be available for you to borrow, because the cost of that money is now far more expensive, unless home prices collapse. In which case, I would love to be able to buy a half price home, and I wouldn't mind paying a higher interest rate for it because the economics make sense. It's too good of a deal. And while I don't know what the future looks like, although I think I know what will happen, as of today, there is no housing recession in South Florida. In fact, in the most recent data in Boca Raton and surrounding areas, we've seen in some instances double-digit appreciation for February. And again, it's March and the market's changed. And frankly, I hope the appreciation normalizes faster because double-digit growth is not sustainable and makes it unaffordable for lots of people who want to buy homes. But the truth is, I don't see any evidence of a housing crash in my local market anytime soon. And the reason for that is scarcity of resource and a lack of supply. And what you can see in this chart, and again, this is a macro picture, this is the US housing number, but the total listing count for the United States in March was the highest. It was March of 2020, so obviously this was during the pandemic. There were damn near 2 million total listings in March. And if we go back to a more normal, balanced, healthy market and go to 2017, you'll see there were 1.4 total listings available. Total supply of listings available. And today we are under 1 million, which means there's an undersupply of homes in the United States housing market. But it all comes down to supply and demand. And as you can see on this graphic, while the number of homes for sale is increasing, It's damn near 50% lower than where it was before the pandemic. But to be totally transparent, compared to the recent past, there is a lot more supply. And you can see that in 2021 and 2022. And you can clearly see that demonstrated in 2021 and 2022. That's why we had such an insane increase in home values. There was tremendous demand at very low interest rates, and there was an undersupply of homes. And when that's the dynamic, you can bet your sweet Bippy there's going to be multiple bidding wars. People are going to waive every contingency, and they're going to pay a premium to get their dream home because of the massive shortage of supply and the massive surplus of buyers who could go out there and buy a home at 2, 3, and 4%, which is obviously not what today's market looks like. And to be clear, this is a macro picture. This is not hyper local, but it is good information for you to understand, which takes us to the change in inventory map month over month for February 2023. And I'm not going to share every single one of these housing markets in every state because we'll be here all day. But if you are interested in getting this PDF, I would be happy to send it to you. Please reach out and I'll send one right away. But what you can see is the month over month change in inventory is all in the orange. The national average is down 6.1%. In Florida, they say it's down 1.5%. Now, I don't believe that's an accurate number, but it's representative enough to give you an idea of what's happening. There has been a massive change in inventory to the downside. But if there's not enough inventory, then new construction, new homes, that will be the solution, right? Well, maybe if you've got the land to be able to build new homes. But in Florida, there's scarcity of land. There's not a whole lot of options. That's simply not a realistic expectation in my hyper-local market because there is no land. But again, this is the national picture. And what you can see here is that single-family housing units completed have been below the 52-year average for the last 14 years consecutively. And as I've mentioned in the past, every market trades differently, but I know for certain that there are markets out there right now where builders are cutting deals aggressively. In Phoenix, in Boise, in Austin, Texas, and other markets, there is a tremendous oversupply of new construction homes that they want off their balance sheet. So they're cutting deals. They're offering incentives. They're doing whatever it takes in order to move that inventory. And so it's critical you work with someone who understands the hyperlocal market in order to negotiate and advocate for you the right way. Now, I serve and support the South Florida market. If you're in any other market anywhere in the country, I can connect you with someone I know, like, trust, an all-star professional who will be able to get you the best deal irrespective of market conditions. And if you'd like me to connect you with an all-star, please reach out and I'll be happy to make that connection right away. But while we're on the subject of supply, let's talk about what the housing market is short in terms of millions of homes. Because despite what anyone else out there tells you, the truth is there is an undersupply of homes relative to people who want to buy them because they need shelter. They need a place to live. But according to Realtor.com, there's a shortage of 5.24 million homes. Bank of America says there's a shortage of 4 million. Freddie Mac says there's a shortage of 3.8 million. Morgan Stanley says it's a shortage of 2 million. John Burns Consulting, shortage of 1.7 million. And Moody's Analytics, a shortage of 1.6. Now, I don't necessarily trust any analyst's opinion. So I don't necessarily agree that the numbers that they're coming up with are accurate as far as the shortage is concerned. The one thing I do agree with is when all of the analysts, when all of these institutions agree on one thing, it's usually accurate. So while the number might not be totally accurate, I do believe a massive shortage of homes, which again brings us back to supply and demand. And if there are not enough homes for people who want to buy them, home prices go higher. But I know you're all asking the same question right now. How much have prices fallen from the peak? Now, to be clear, I don't agree with what these numbers are. And I've done lots of content recently describing the changes that have happened in the Florida housing market. But this is a national picture and it's instructive. I don't believe it's totally accurate, but I do agree that the trend is right. The drop in home values since the June peak through December 2022, according to Moody's, is a drop of 1%. According to FHFA, it's been a drop of 1.6%. According to Case-Shiller, which I think is probably the better number of the three, there's been a drop of home prices to the tune of 2.7%. And I'll loosely translate that for you. The US housing market has lost something close to $2.7 trillion in equity in the last year. Which brings us to the question, which is, should I buy a home right now? And to be totally transparent, you should only buy a home right now if you've done your due diligence and totally understand what the risks, what the rewards, and what your financial future looks like, what your financial status is. You must audit yourself and your life completely to understand what it costs for you to live the lifestyle that you are accustomed to or want to enjoy. Because if the numbers don't make sense, you should not buy a home today. And if you're stretching yourself and you're banking on the possibility that you can marry the home and date the rate, I would tell you, do not buy the home. Because I think it's possible that interest rates can come back down when inflation and home values start to cooperate. I also know that the Fed is hell-bent on doing what they must to stamp out inflation. And while I hope you do have the ability to refinance at a lower rate, I don't know that that's going to happen anytime soon. And we only need to refer back to the chart that we talked about earlier, where you saw mortgage interest rates were damn near 18%. And if you're forcing yourself into a house at a rate that you really can't afford and you're sacrificing quality of life to do so at 7+% on the hope that you can refinance at 2%, let me just disabuse you of that notion, because mortgage interest rates are not going down to 2% ever again in our lifetime. And if they do, I'll be happy to eat my words. That would be wonderful. But the odds of it happening are slim to none, which is a long way of getting to, if you cannot afford the mortgage interest rate that you are agreeing to when you get a loan, don't buy the home, because you will regret it. You will have buyer's remorse and you will be in a very tough lifestyle position. And God forbid something changes in the future and you lose your job. Well, now you're in big trouble. And that's when distressed sales and forced sales start to hit the market. And I pray that everybody who watches my content is empowered enough to never be in that situation. But I know there's lots of folks who will. And while that's unfortunate, it is bound to happen, which takes us to rents and takes us to the massive explosion in what rentals cost. Because the average rent price since 1988 has increased exponentially. And to be clear, this is a national number. It's not what's going on in my hyperlocal market. In my hyperlocal market, it is much worse than this. There's almost no chance that you're getting yourself into a nice single family home rental for $1,400. Not going to happen. So let's dive in. And what you can see is in 1988, you could get a rental for right around $350. And if we fast forward to Q4 of 2022, that number has increased to almost $1,400. That would be terrible if you were the tenant. And that would be incredible if you were the landlord. So please don't be confused. If you're a tenant, you're paying a mortgage. You're just paying your landlord's mortgage. And if you're the landlord, well, congratulations, because you're benefiting greatly and will continue to do so into the future. And again, to be clear, we're talking about a national number. I'm talking more hyper-locally. The rental market in South Florida is insane. Rents have gone through the roof, and the landlords here who are benefiting from that are benefiting all the way to the bank. They're thrilled they've got those rental properties. Now, to be clear, pain of recession and distressed sales and all the bad things can happen, can radically impact what the rental market looks like, just like it can radically impact what the resale market looks like. But as of today, as of right now, none of those things are on the table in the near term. Which takes us to the forecast everybody wants to know about, which is the estimated national price performance for single family homes, and December to December as forecasted in Q4 2022. And what you'll notice is that analysts are calling for a decrease in home values in 2023 to the tune of negative 1.61%, which, to be clear, is single digit depreciation. And again, this is national, it's not hyperlocal. I'm calling for single digit growth across the board in almost every Florida housing market. But as evidenced by the most recent numbers in Boca, there's been double digit growth. It has been insane appreciation. I don't expect we're going to see that as we trend into 2023, 24, 25, but I do think we'll go back to normal appreciation, and I do think that will look like single digit growth, which is exactly what they're calling for on a national level, which looks like 1.9% in 24, 3.57 in 25, 4.25 in 26, and 4.44 in 2027. And to be clear, this is an analyst's opinion, and there's a lot of information that I don't know as to how they came up with these numbers. So I don't necessarily agree with what they're saying here, but I do agree that the trend is likely to be moderate growth. But Chris, we all want to know, what does that growth look like? Well, let's look at this map and see what the percent change is in home prices since Q1 of 91 to Q4 of 2022. Now, to be clear, we are in Q1 of 2023. So what we're looking at here is definitely dated. It's definitely lagging, but it's instructive. And what you're going to see is that the entire country has benefited greatly from home appreciation. Almost every single market here has increased exponentially. And if we look at Florida, what you'll see is massive, insane, unsustainable appreciation to the tune of almost 430%. 430%, which is muy caliente. But the national average is 289%. And you can look at some of these other markets too. Texas up 332, California up 300, Oregon up 511%, Montana up 570%, Utah up 588%, New Jersey up 245, Connecticut up 149, New York up 250%. If you bought a home in the first quarter of 1991 and held it through till now, I got great news for you. I hope you dusted off your spacesuit because boom, we're going to the moon, baby. Courtesy, of course, of Elon Musk. And if you're interested in knowing about some pre-construction deals that will likely be available on Mars or on the moon or wherever it is that he's going to go, please reach out because I'd love to get you registered right away. Which takes us to our final slide. And I think this is very helpful if you're thinking about buying or waiting or renting. It will give you some context as to what is likely to happen to your household net worth by doing so. And what you'll see is the potential growth in household wealth over the next 5 years based solely on increased home equity if you purchase a $400,000 home in January of 2023. Well, that's impossible because it's now March of 2023, but the logic still applies. And what you'll see is price appreciation, which was projected by the Home Price Expectation Survey. And to be clear, it's a survey. So I don't know that I necessarily trust what their expectations are. And separate to that, we're talking about a national level. We're certainly not talking about what's going on in my market. In my market, it will be significantly more than this. But what you can see is an average increase to your net worth of roughly $54,000. $54K. And that's just the equity. It completely leaves out some of the other benefits included with home ownership, like depreciation and tax write-offs and a million other things too. And in Florida with Homestead, you've got much better benefits that exist also, but I'm not going to go into all that right now because we'll be here all day. Now, I hope you found this content valuable, and if you did, please subscribe to the channel, give it a thumbs up, leave a comment down below, and if you're thinking about buying or selling, we would love to help. Please reach out directly and check out my next video because I suspect you will love it a lot. And until next time, peace.